reporting. One thing about this RTP is there are few new questions, but nothing complicated. If you know the concepts, they are more straightforward and you can solve them easily, no challenge at all. And a lot of questions are the standard repeated questions which you would have already done in the classes or by referring to the study material or the past exam papers. So without wasting much of time, let us start the discussion. The first one is case scenario based MCQs. Now, I've been telling this earlier as well, and whenever you see a case scenario based MCQ, quickly look at the questions, because based on the questions you can figure out what are the important points in the case which you need to solve it. It will not take more than a minute, right? So first is when and by what amount the revenue be recognized with respect to sales made on 1st of October. So they are asking when and by what amount should we recognize revenue. Then what will be the amount of finance income, so interest income. What will be the amount of trade receivable. Then what will be the amount of revenue to be recognized with respect to sales arrangement with B Limited. So there is one more entity, and amount of revenue recognized in the year 6-7 with respect to sales arrangement. So basically it's asking revenue, finance component and trade receivable balance. Now let's look at the case. On 1st of October of 2006, I read it as 2006 so that we don't get confused. Okay, so X you treat it as 0. D Limited sold a product to a customer for 1,21,000. So this is the price at which they have agreed. This amount is payable on 31st of December of year 8. So 2006, 2008, it is paid after 2 years and 3 months. Okay, so this 1,21,000 will include what? Significant financing component. So we have to discount that 1,21,000 to recognize the revenue. The manufacturing cost of the product for D Limited was 80,000. The customer had a right to return the product for a full refund at any time up to and including 31st December of year 6. So the customer has a right to return. The customer has a right to return and take a full refund. Till what period? Till 31st December. At 1st October, D Limited had no reliable evidence regarding the likelihood of the return of the product by the customer. So D Limited cannot determine, does not have the evidence whether the customer will return the product or not. In that case, will we recognize revenue? See, when we don't have evidence, how can we recognize revenue? Right? The product was not returned by the customer before 31st December of year 6. Not returned means what? They have accepted. When they have accepted, on this date, see, on 1st of October, we don't have evidence. On this date, we can recognize revenue. On 31st of December, we can recognize the revenue. So the right of return for the customer expired. On both 1st October and 31st December, cash selling price of the product was 1 lakh. So whenever there is a deferred consideration involved, we recognize the revenue at what value? At the cash selling price. And what is that amount? 1 lakh is the amount. Okay. So if you discount 1,21,000 by 10% rate, you will get 1 lakh itself. So the first question, when should we recognize? On 31st of December, not on 1st October. So see, if 3 options are out because of 1st October, so directly you can say 31st of December and revenue is 1 lakh. What will be the amount of finance income to be recognized with respect to sales in the year 6-7, that is 31st March of year 7? If you see, we have 3 months. See, sales is recognized on 31st of December. 31st of March is the year end. So the number of months is 3. Don't take 6 months. We are recognizing revenue on 31st December. So from that date, the next 3 months, interest will be 10% and the sale value is 1 lakh. 1 lakh into 10%, 10,000 divided by 4. How much? 2,500. What is the amount of trade receivable balance? 1 lakh sale value, 2,500 interest value, 1 lakh 2,500. So 6 marks, straightforward. Okay. In fact, a lot of students have shared their certified copies, including some rank holders, where they have got 30 out of 30 in MCQ. So once you get 30 out of 30 in MCQ, getting the balance 30 marks is not a big challenge, right? See, if you can cross 60, it's more than enough. Then the next case. On 1st of July, D Limited began an arrangement to sell goods to a third party, B Limited. Here, D Limited sold to a customer. Here, to a third party, B Limited. The price of the goods was set at 100 per unit. So this is the transaction price for all sales in the 2-year period ending on 30th of June. So from today, for the next 2 years, price agreed is 100. However, if the sales of the product to B Limited exceed 60,000, if he buys more than 60,000 in the 2-year period, then the selling price of the units is retrospectively set at 90 per item. Historically, will go historical sales also, the value will be or the price will be 90 per item. Sale of goods to B Limited in the 9-month period ending on 31st March of year 6. So this is 31st of March of year 6. Here, This is year 6. This is 31st March of year 7. Okay, so that was sale happened in year 6 and the transaction was on 31st March of year 7. So we have to be very careful while reading the dates. Okay. Uh, yeah. Total 20,000 units, and this volume of sales was not expected to change before 30th of June. So totally they sold 20,000 and they do not expect that the number, the cutoff number of 60,000 would be breached. However, in the year ended 31st March of year 7, 31st March of 2007, total sales of the goods to B Limited were 35,000. And based on the current orders from B Limited, the estimate was revised. The directors estimated that total sales of goods to B Limited in the 2-year period ending 30th of June would be more than 60,000. Means in 31st March of year 6, it has not breached. So whatever we have sold into 100 will be the revenue. And for the next period, it will exceed 60,000. If it exceeds 60,000, what is the price? 90. So what you will do? Total revenue considering 90, that will be the total revenue minus revenue already recognized. The difference you will recognize in the current period. Okay. So what will be the amount of revenue to be recognized in the year 5-6? So basically you have sold 20,000 units into 100. How much is that? 20,000 into 100. 20 lakhs is the revenue that you would be recognizing in the first period. Okay. Then what will be the amount of revenue to be recognized in the year 6-7 with respect to the sales arrangement with B Limited? Now what happened in 6-7? In the year ended 31st March, total sales of the goods to B Limited were 35,000. Okay. So 35,000 and you are saying that they will exceed. So for this 35,000, we will consider 90 only. So 35,000 into 90, and previously whatever we have sold, that 20,000 also we have to record. We should have recorded at 90. See, now the period has passed by. So what happens? 55,000 multiplied by 90. So that is 55,000 multiplied by 90. If I do, I get 49 lakhs 50,000. This is the cumulative revenue. How much already recognized? 20 lakhs. So minus 20 lakhs if I do, I get 29 lakhs 50,000 to be recognized. Okay, so and it's very straightforward. See, to make things more complicated, what they could have done is they could have taken 35,000 into 90, one number. Okay, that becomes 31 lakhs 50,000. That they could have given as an option, which they did not give. Okay, so if I were an examiner, I would have said this is 31 lakh 50,000 to make you confused. Okay, here it is straightforward, 29 lakhs 50,000. So if you just cross check the answer, 1 lakh, then 25, 1 lakh 2,500, all. Then 20 lakhs and 29 lakhs 50,000. Right? Simple and straightforward. Right? So let's move to the next one. This one is based on some scenarios. Mrs. XYZ and Company is an auditing firm. During the audit, the firm is facing difficulty in the accounting of the following transaction. A Limited has established a defined benefit pension plan for its eligible employees. The balance sheet of A Limited as on 31st March includes the estimated net liability at 31st March of year 6 amounting to 18.75 crores. So we are preparing on 31st March of year 7. This 31st March of year 6 balance, opening balance is 18.75 crores net liability. So there is a net liability or defined benefit liability, right? The following matters relate to for the year ended 31st March of year 7. The estimated current service cost was advised by the actuary to be 6 crores. Now, what is this? This is my expense. What will I do? What will happen to my liability? This expense will increase my liability. Okay. So in this standard, the most important thing or the question that is asked again and again is calculation of the net liability. So we'll take the opening liability. Current service cost will increase the liability. If you have any doubt in this standard, the entire Ind AS 19 is available for free on YouTube, fully animated. You can have a look at it. Right? On 31st March, they paid contributions of 7 crore into the plan and charged this amount as an operating expense. Okay, so we paid the money. When we make a contribution, our liability comes down. But instead, what did they do? They debited that to P&L. So this has to be corrected. The annual market yield on high quality corporate bonds on 1st of April was 8%. Okay, so Opening balance is 18.75. On this, your interest cost at how much? At 8% should be calculated. So 18.75 into 8% if I do, I get 1.5. Okay, this will increase. Then the contribution to plan assets will reduce. So 7 crores I should reduce. The estimated debt liability on 31st March was advised by the actuary to be 20.5. So what will happen to this if I do 18.75 plus 1.5 minus 7, I get 13.25, and okay, so current service cost is also there. I forgot to add that. The estimated current service cost was 6 crores. So I need to add that as well. So plus 6, I'll do it here. Sometimes in a hurry, we also tend to miss. Right. So 19.25 and closing balance is 20.5. Okay. So this is the expected. This is the actual. Expected minus actual. What is the remeasurement gain or loss? 19.25, and now they are saying 20.5. It should have been 19.25 liability. It is 20.5. So 20.5 minus 19.25, we get 1.25. This is our loss. Okay, so this is the loss, this is the interest cost, this is 6 is the service cost, and 7 is the contribution. Now let's see what is the thing. No benefits have been paid. Okay, on the basis of facts given, choose the most appropriate answers. What is the amount of net adjustment to be made in the statement of P&L for the year 6-7 with respect to defined benefit pension plan? They're saying net adjustment. Now here in these type of questions, application is very, very important. They are not saying what is the amount to be charged. If they say what is the amount to be charged, we would have said 6 plus 1.5, it is 7.5. This is the expense, current service cost and interest expense. What they are saying, adjustment. Now what is the adjustment? See, this 7 crores that we have paid, we have already debited to P&L. So 7.5 should be the expense. 7 already has been expensed. So the net adjustment is 0.5. 7.5 minus 7.5 crores. So option C is the correct answer. 0.5 crores deducted from the P&L of 6-7. Right? Then what is the amount of actual gain or loss on defined benefit pension plan for the year 6-7? 1.25, which we have already calculated. What is the original provision required to be made on account of oh, sorry, this is the next part. Okay, so this is 0.5 and 1.25. I think we have done the correct one. Zero 0.5 and 1.25. Okay, so both of these are correct. Then the second one, this is similar to the questions that we have again, the one which we have discussed, and this also is similar. On 1st April of year 2XX0, 2000, E Limited completed the construction of a non-current asset with an estimated life of 20 years. Cost of construction were recognized in PPE and depreciated appropriately. E Limited has a legal obligation to restore the site on which the non-current asset is located on 31st March of 2X20, so 20 years. The estimated cost of this restoration work at 31st March 2020 prices is 2.5 crores. The directors have made a provision of 0.125 crores in the draft balance sheet of 31st March. An appropriate annual discount rate to use any relevant calculation is 6%, and at this rate the present value of one payable in 20 years is 0.312. So what should they have done? This is again a question which I have already done earlier also. What should they have done? They should have done 2.5 crores multiplied by the factor 0.312. So 2.5 into 0.312, how much is that? 2.5 into 0.312, if I do 2.5 into 0.312, I'll get 0.78. This has to be added to the cost of PPE. What they have done is, they have made a provision of 0.125 crores in the balance sheet. So when they have made a provision of 0.125 crores, that is not correct, that has to be reversed. Okay, so what is the question? What is the original provision required to be made on account of restoration of non-current asset? Original provision should be 0.78 crores. Okay, so that is the original provision which is required to be made, which is 0.78 crores. Then what will be the amount of adjustment to be made in the retained earnings on account of restoration provision? Now, when we say retained earnings is the net impact. What is the net impact? See, net impact is one, you have to reverse that 0.125 whatever has been charged. So here they have said they have charged 0.125 crores. Now we have already made a provision. We will reverse that. It will increase our retained earnings. So that will increase our retained earnings 0.125. This will increase my retained earnings because I will reverse. Then I have to make a provision of 0.78. Will that impact my retained earnings? It will not. But the interest cost on 0.78 multiplied by the relevant discounting factor is given to be 6%. So 0.8 into 6% if I do 0.78 into 6% if I do 0.0468 this will reduce. Okay, then the third thing is the depreciation part. Now depreciation is on 0.78 divided by 12. If I do, I get 20. Depreciation should be 0.78 divided by 20. If I do 0.78 divided by 20, 0.78 divided by 20 is 0.039. Okay. Now this 0.125, I think what they refer to is they have added to PPE and they have reduced from the, or they have created a liability, not reduced, they have created a liability. So 0.468 is towards the interest component, which will be an interest expense that has to be recognized during the period. Then 0.039 is the additional depreciation or the depreciation on the provision PPE amount that needs to be provided. Okay, so 0.468 plus 0.039, 0.468 plus 0.0468 plus 0.039, it is 0.0858. So I think I have not articulated properly. So we have 0.0468 one number and depreciation of 0.039. So if I do 0.0468 plus 0.039, I get 0.858. And what they have made is 0.125 is what they have made. So 0.125 minus 0.858, what I get is 0.125 minus 0. 0.468 plus 0.468 plus 0.039. I get 0.0468 plus 0.039. It is 0.0858 minus 0.1250. I get 0.0392. Okay, so this is the number. So what I have done initial was only the correct one. They have made a provision, means this amount they have already debited to PNL. They should have actually debited only these two amounts to the PNL. Of course, now when the difference of these two comes, it is 0.0392, which matches with the option C. Okay, slightly twisted and lack of space made me confused. Then what is the amount of 1 year unwinding of discount on account of restoration provision? Unwinding of discount means what? The interest expense. So we have calculated 0.0468. So 0.0468 is the interest number which will be provided. That is the unwinding of discount. Then moving on to the next one. X Limited, an Indian company, owns a freehold land with a carrying value of 10 lakhs, which is not depreciated for tax purposes but is indexed for inflation. Indexed value and fair value of such land is 15 lakhs and 22 lakhs respectively. Now, carrying value of freehold land is 10 lakhs. It is not depreciated both for books and also for tax purpose. It is indexed for inflation. Now, indexation is used when we have capital gains. Okay, so when you have capital gains, we can get indexation. Of course, the recent Finance Act has amended all of this, but don't consider that. Consider what is given in the question. Okay. Index value and fair value is 15 and 22. So if it is indexed, indexed value is 15 lakhs. So while calculating your capital gains, you will get a deduction of 15 lakhs, which means the amount that will be deducted or the amount that will be available as deduction against this particular asset is 15 lakhs, and that 15 lakhs becomes my tax base. The fair value is 22 lakhs. Now fair value is applicable for land only if you are following revaluation model under Ind AS 16. If I am taking it as an investment property, I do not have the option of fair value. What will be the tax base for such freehold land for measurement of deferred tax if X Limited intends to sell it as a part of some sale of business eventually after using it for business purpose? Now, if you know taxation, when there is a slum sale kind of a thing, you take the entire asset and you sell it at once. Okay, and there you calculate everything is called becomes short-term capital gain, and indexation and all is not given. Right? X Limited intends to sell the land individually and not on a slum sale. X Limited has classified such land as investment property. Here investment property if you do, then revaluation model is not allowed. Fair value model is not allowed. And intends to sell it individually and not on a slum sale basis. X Limited follows a revaluation model for freehold land. You may say, sir, how revaluation for freehold? You are applying Ind AS 16 and intends to sell it individually and not on a slum sale basis. As per the applicable tax laws in the jurisdiction, index benefit is not available if the freehold land is sold as a part of slum sale, but indexation benefit is available if freehold land is sold individually. If you take it as a slum sale part, it is a short-term capital gain. There is no indexation. We learn in income tax also. If this was not given, you should have applied the relevant knowledge of income tax and solved the question. Right? Now, what is the question? What will be the tax base for such freehold land for measurement of deferred tax? So we need the tax base. If you sell it as a part of slum sale, then indexation is not available. So your cost of 10 lakhs, for this cost of 10 lakhs itself will be your tax base. X Limited intends to sell the land individually, then 15 lakhs will be your tax base. X Limited has classified such land as investment property and intends to sell it individually, then also it becomes 15 lakhs because you get an indexation benefit. X Limited follows revaluation model and intends to sell it individually. Here also your tax base is 15 lakhs. Simple and straightforward. Now, though they have not asked, but the other thing that you have to see is what is the carrying amount. If you sell it as a part of slum sale, carrying amount will also be 10 lakhs. So, carrying amount will also be 10 lakhs. Here, sell the land individually and not on slum sale. Here also it is 10 lakhs. Classified as investment and intends to sell individually. Here also 10 lakhs. Follows revaluation model, then it will be 22 lakhs. Right? Then difference here, no difference, so no deferred tax implication. Here 15, 10. So you get a higher deduction for tax purposes, right? So this will eventually create a deferred tax asset, and for the difference you will recognize. Same thing here. Here it becomes just return. So if you just look at the answer. So there will be no temporary differences, which we have already discussed. Book base of the land will be 10 lakhs. Deductible for tax purpose will be 15 lakhs. Deferred tax asset will be set up on the difference of 5 lakhs. Then here again deferred tax asset on the same principle. Here it will be a deferred tax liability because balance sheet value is 22 lakhs, but deductible amount is not 22 lakhs. Then these leases related questions are similar questions based on concepts that we have discussed. So you can have a look at the question and the answer. You'll be able to figure out. There is nothing complicated or new that you'll be discussing here. India's 41 agriculture, here also very simple. They have given two cases. One contract where the vendor manages the agricultural process. Second contract where the customer manages. So when the customer manages the biological transformation, it becomes an agricultural activity. When the vendor does the biological transformation management, when they do all the management of the entire orchard and everything, and they give you the final product, it is not an agricultural activity. Again, a simple concept based question. Then events after the reporting period, already similar questions as we have discussed in the class. Then India's 36 impairment of assets, just a couple of things that you have to keep in mind. The rest of the question is pretty simple. Okay, so let's look at this. At 31st of March of year 1, assets of a CGU are being reviewed for impairment. Carrying value of the CGU's net asset is 65 lakhs, excluding any restructuring provision. So 65 lakhs is the carrying amount. If at all you have to create any restructuring provision, it becomes a liability. So you'll reduce that restructuring provision, and this amount will be your carrying amount. Management's approved budgets at 31st March year 1 include restructuring cost of 350. So this will be 3.5 lakhs. To be incurred in year 2. The restructuring is expected to generate cost savings of 1 lakh per annum from year 3 onwards. So now what you have to do is, when you're doing an impairment, if you do the restructuring, if you're making a provision of the restructuring cost, then the revised cash flows after restructuring should be considered. If you are not doing any restructuring cost activity, if you are not providing for any restructuring provision, then the existing cash flow projection should be considered. Formal budgets have been prepared for the 3 years on 31st March year 4. A zero growth rate is assumed because the market conditions are extremely competitive, and this is expected to continue for the foreseeable future. The future cash flow estimates are as follows. So this is the, if you restructure, this is the cash flow. Without restructuring, this is the cash flow. In year 2, the net cash flows without restructuring is 870, exceed the net cash flows with restructuring by the amount of the restructuring cost 350. So basically 520, 870 here with restructuring, because what you are doing, you are incurring 350, so 520 plus 350, if you see, this becomes 870. After that, there is a difference of 1 lakh 50 here. The future cash flows, which include inflation, have been discounted at the rate of 4%. For simplicity, it is assumed that the cash flows arise at the end of the year. Compute the impairment loss on 31st March when restructuring cost is recognized in the financial statements. Restructuring cost is not recognized in the financial statement. Now, students, here with restructuring consideration, it is 65 lakhs. Right? So 65 lakhs is the carrying amount of the asset. With restructuring, you have a liability. Without restructuring, you don't have liability. Right? So now what I have to do is, if you look at the solution, you have to calculate the discounted cash flows considering 4%. Yeah. So with restructuring consideration, future cash flows, this entire thing, discount using the factors, using the factors at 4% without restructuring. So this is the value in use. Now value in use, what you will do, you will compare with the carrying amount. So 65 lakhs is the carrying amount, restructuring provision 3 lakh 50. If you do this 65 minus 350 and compare with the value in use, the value in use that is got here is 6514. So it is higher. So after restructuring, there is no impairment. There is no impairment. Without restructuring, if you see, the carrying amount is 65 lakhs and the value in use is 60 to 73. So there is an impairment. Impairment loss has to be provided, right? That. SS Limited had the following transactions during the financial year 1-2. On 1st of April of year 1, SS Limited purchased the net assets of M Limited for 13 lakhs 20,000. The fair value of M Limited identifiable net assets was 10 lakhs. SS Limited is of the view that due to popularity of M Limited product, the life of goodwill is 10 years. First is goodwill. How much is goodwill? You have paid 13.20. You have got net assets of 10. Goodwill is 3.20. Now tell me one thing, do we do amortization or do we amortize goodwill? As far as Ind AS is concerned, goodwill is tested for impairment. But goodwill is never amortized, right? So when goodwill is not amortized, this question of amortization 10 years and all of that should not be considered. Sometimes you may remember what you learned in accounting standard 26 and you may feel that no, we have to amortize goodwill. You should not amortize. Second, SS Limited purchased a franchisee to organize musical shows from ATV for 80 lakhs, annual fee of 2% of musical shows revenue. Now, whatever you pay as a percentage of musical shows revenue, that will be your expense. The franchisee expires after 5 years, so the validity is 5 years. This 80 lakhs, you will amortize it over 5 years. Musical shows revenue were 10 lakhs for the financial year 1-2. Projected future revenues for the financial year 2-3 is 25 lakhs and 30 lakhs for the remaining 3 years thereafter. Now, one thing you have to understand is revenue should be considered for amortization only if it is the limiting factor. If it is not the limiting factor, you should not consider revenue. Limiting factor means like the contract, the rights are there till the time you achieve certain level of revenue. If that is the case, then you can use revenue for amortization. If that is not the case, you should not use revenue as a basis for amortization. So here you will use a 10 or 5 year period. You will take a 5-year period and do the amortization. On 4th of July, SS Limited was granted a copyright that had been applied for by M Limited. During the financial year 1-2, SS Limited incurred 2,50,000 on legal costs to register the patent, 7 lakh additional cost to successfully prosecute a copyright infringement suit against a competitor. Life of the copyright is 10 years. Now 2,50,000 is your intangible asset, 7 lakh to defend your intangible asset is your cost. It's an expense, so you have to charge it off to P&L. SS Limited follows accounting policy to amortize all intangible on SLM basis or any appropriate basis over the maximum period permitted by the Ind AS, taking a full year amortization in the year of acquisition. Prepare a schedule showing intangible section in the balance sheet. Schedule showing related expense would appear in the statement of P&L. So very straightforward, just conceptual clarity. If it is there, it is easy for you to solve it. Right. So intangible assets 3,20,000. For goodwill, no impairment. Then 80 lakhs for the franchisee, depreciation of or amortization of 16 lakhs, 5 years. 2,50,000, depreciation of 25,000. Then what happens to the expenses? The expense that you have incurred. One is amortization, another one is legal cost and franchisee revenue 2%. Franchisee revenue 2% cost, that will be taken as your cost. Okay, so that will be debited to your P&L. So this is what you have to do. Present it in as an extract of the balance sheet and P&L. Ind AS 16 property, plant and equipment. Again, same question. Similar questions have been done in the class. It's a comprehensive question, and you'll be able to do it on your own. There is nothing complicated which is to be considered here. Now, borrowing cost here in this particular question, it's a slightly special question, I would say. X Limited commenced the construction of a company of a plant qualifying asset on 1st of September, estimated to cost 10 crores. For this purpose, X Limited has not raised any specific borrowings. Rather, it intends to use general borrowings, which have a weighted average cost of 11%. Total borrowing cost incurred during the period between 1st September to 31st March was 0.5 crores. Month, cost of construction accrued cash flows paid in advances at the paid in advance at the beginning of the month. So this is on expenditure accrual basis. This is on cash basis. Okay. Now for you to calculate the interest expense is simple because they have given you the rate. The rate is 11%. You can apply 11% into 11% divide into 1 divided by 12. If you do this on this amount or this amount, you'll get the borrowing cost. But which amount should you consider? Now, the suggested answer what has been given as a part of RTP, you have calculated both of them, but then because interest is incurred when you actually pay, that is when the interest is incurred. Otherwise, you have to accrue it. So when the payment happens, that is when the borrowing cost is for the loan is being considered to be used for the purpose of the qualifying asset. So this is more appropriate. So you'll consider this, apply the relevant rate of 11% divided by 12 and calculate the borrowing cost. Other than this, there is no adjustment in this particular question. Consolidated financial statement, one of the simple and straightforward question. I believe you will not get this easy question in the examination. If required, you can go back and see what they have tested in May 24 or what they have tested in November 23. Pretty complicated. There are some areas where even all the faculties have not been able to come to a common conclusion that yes, this is the correct approach to solve that question. It's a very simple and straightforward question. If you have done consolidation, you can handle it very easily. So there is no point in doing it again. Then joint arrangements, again a simple question. We'll just quickly discuss it through. P Limited and Q Limited enter into a contractual arrangement to buy a building that has 12 floors. So there are 12 floors. There is a contractual arrangement which they will lease to other parties. P Limited and Q Limited are authorized to lease 5 floors each. So first 5 floors and second 5 floors or any 5 floors. P and Q are authorized. P Limited and Q Limited can unilaterally make all decisions related to the respective floors and are entitled to all of the income for those floors. So out of 12 floors, 5 floors B is controlling. Is there any joint control? There is no joint control. Remaining 5 floors Q is controlling. Is there any joint control? Again, there is no joint control. Remaining 2 floors will be jointly managed. All decisions concerning these 2 floors must be unanimously agreed to between P Limited and Q Limited, who will share net profits or net losses in respect of these 2 floors equally. They have rights to the net assets of the arrangement. Now, generally, when you have the rights to the net asset of the arrangement, you call it to be a joint venture and not a joint operation. The leasing of the property is determined to be a relevant activity, whether it's a joint operation or a joint venture. Now, one thing that you have to keep in mind is, if a separate entity is not formed, they have not said they have formed a separate entity. If a separate entity is not formed, we will not be able to classify this as a joint venture. Though they have given it as a joint venture in the answer, unless you say that yes, P and Q have formed a joint venture called PQ, let us say LLP or PQ Limited, a new entity or a new venture. If there is an entity, then you can say it to be a joint venture. Now here it can be called a joint venture if they have formed a separate entity and they have right to net assets. That is, second part is given in the question. First part is not given to you in the question. So accordingly, you will have to write the answer in the examination. Right. Now, there's one more question on Ind AS 10. Which is event occurring after the balance sheet date, and there is a component of aspects regarding what will happen and whether there is impairment and all. So we'll just quickly have a look at it. H Limited constructed a warehouse at a cost of 10 lakhs in year 1. It first became available for use by H Limited on 1st of April of year 2. On 29 April of year 6, H Limited discovered that its warehouse has been damaged. During early May 6, an investigation revealed that the damage was due to a structural fault in the construction of the warehouse. The fault became apparent when the warehouse building leaked severely after rainfall in the week ended 27 April. Discovery of the fault is an indication of impairment. So now what happened? We constructed a building or a warehouse. Right? Now that warehouse was under operation, and over a period of time, because of heavy rains, it started leaking. Then we realized that there is a structural fault. Means there is a condition which existed previously which we were not aware of, and subsequently this resulted in getting the warehouse leaked, and because of which it became it is an impairment issue as well. H Limited was required to estimate the recoverable amount of the warehouse on 31st March. The estimate was 6 lakhs. So this is the recoverable amount. H Limited reassessed the useful life of its warehouse at 20 years from the date that it was ready for use. So when was it ready for use? 10 lakhs in year 1, first available for use on 1st April of year 2. So from 1st April of year 2, then we have year 3, then we have year 4, then we have year 5. All of these happened in year 6. So April 2 to April 3, 1 year, 2 year, 2, 3 and 4 years. 4 years have been completed. Okay. So for first 3 years, you will charge depreciation considering that it has a useful life of, before discovering the fault, they have charged depreciation considering 30 years. So before means in the first 3 years before this event happened. So when did the event happen? Year 6. So when you are adjusting the 31st March of year 6 balance sheet, when you are doing that, in that year you will consider 20 years for depreciation purpose. But before that, whatever depreciation has been charged, you will consider 30 years. Okay. Seepage of rainwater through the crack in the warehouse caused damage to inventory worth 1 lakh and became unsaleable. The entire damaged inventory was on hand as of 31st March. H Limited has not insured in the property. It accounts for all property, plant and equipment under the cost model. Annual financial statement for the year ended 31st March were approved on 20th May. So event happened before this. Evidence came before that. So do you need to go back and adjust? Yes, you have to go back and adjust it in the financials ending 31st of March of year 6. Prepare the accounting entries to record the effects of the events after the end of the reporting period. Ignore the tax impact. Requirement as per the relevant India's disclosure, and answer be different if there was no structural fault. So 3 things here. Quickly if you see. Yeah. First is original depreciation of S for SLM during the year 5, 6, 10 lakhs divided by 30 years, 33,333. Then subsequently, what you have to do is you have to determine what is the carry. So basically, things changed on 31st March of year 6. What is the carrying value till 31st of March of year 5? So that is 3 years depreciation. 10 lakhs minus 33,333 into 3, 9 lakhs. So this is the carrying amount. Now this 9 lakh has to be depreciated over 17 years, remaining useful life. So which comes to 52,941. We were charging only 33,333. Now we need to charge 52,941. The difference 19,608 should be provided. I am repeating once again. In the year we have charged already 33,333 of depreciation. So how have we charged? Because the year has already ended. Revised depreciation after considering revision in the estimated useful life is 52,941. So the difference has to be provided 19,608. So additional depreciation 19,608. Then calculating the impairment is straightforward. So what I have to do is from this 9 lakhs, you will reduce the total depreciation of 52,941. You get 847,059. That is the carrying amount. Recoverable amount is 6 lakh. So the impairment is 2,47,015. And regarding adjustment and all, let us discuss. The damage to the warehouse is an adjusting event occurred after the end of year 2005-6 for the reporting period 5-6, since it provides evidence that the structural fault existed at the end of the reporting period. Sir, can we go back and adjust the previous financial years? Because see, the balance sheets have been issued. The board has already signed it off. Okay. Prior period means, the subsequent event means events which occur, which provide additional information after the balance sheet period, before the board has approved or the appropriate authority has approved the financials. So it becomes an adjusting event. Okay. So you will adjust that. Second, inventory damage is not an adjusting event because damage happened after the financial year end. So this will be a non-adjusting event. If the damage to the warehouse has been caused by an event occurring after 31st March, it will be considered as a non-adjusting event. Okay. So just that, you have to present it appropriately, and calculation you have to be slightly careful with the respective things. Okay. I hope you have been able to understand this. If you are able to solve this RTP in the first go, all the questions, you can consider that you're at least 60-70% prepared for the examinations. Some of the questions are simple and straightforward. Don't expect such simple questions in the examinations, and especially when a lot of students have passed in the previous attempt, maybe there is a chance that the paper might be at a tougher level. Anyways, trust your preparation, trust your concepts, and you will do good in the exam.